6 months ago, OpenAI told the world they were going to build humanoid robots. Then they didn't. Then they quietly invested in 3 of them: Figure AI, 1X Technologies, and Physical Intelligence. This is the story of why the smartest investors on the planet are hedging across humanoid robotics, and what it tells us about the next decade of automation. We mined 1,000 companies, nearly 1,000 supply chain edges, and triangulated every layer of the robotics stack. The answer is more interesting than the press releases. There are 2 robotics races happening simultaneously, and they are completely different bets. The first is industrial robotics. This is a mature, multi-decade business. Roughly 600,000 industrial robots ship globally every year. It is profitable. It has dominant players. The 4 leading manufacturers, FANUC, KUKA, and Yaskawa, sometimes called the Big Four, control around 70% of installations. The second race is humanoid robotics. It is pre-product, pre-revenue, and over $30 billion of capital has already been committed. Different game, different risk profile. The interesting question, and the question every smart investor is now asking, is which race bridges first? Why does this matter right now? 3 things changed. 1. Foundation models broke through the perception barrier. Vision language action models can now translate human-readable instructions into robot motion plans, including for tasks the model has never seen before. 2. Hardware costs collapsed. Unitree's H1 humanoid sells for around $16,000 retail. A decade ago, that would have been a $100,000 research platform. 3. Capital coordinated. In the last 18 months, Microsoft, NVIDIA, OpenAI, Bezos, Amazon, BMW, Intel, Mercedes, Tencent, Bide, LG, Tether, and Apple have all written checks into humanoid robotics. When that many strategic acquirers move at once, something has been priced in. The question stops being whether robotics matters and starts being which layer captures the rent. Before we dive in, the map. The robotics stack is 11 layers deep, from raw materials at the bottom to capital at the top. Materials: rare earth magnets, specialty alloys; mechanical bearings, harmonic drives, gearboxes; actuators, motors, linear drives; sensors, LiDAR, cameras, force torque, inertial; compute, NVIDIA Jetson, Qualcomm, Edge AI chips; power, batteries, and power electronics; software stack, ROS, simulators, physics engines; foundation models, GR00T, Helix, Gemini Robotics, Pi; form factor, the body itself, humanoid or otherwise; integrators, the system builders; and on top, capital. We are going to walk through each layer that matters. Some are profitable today, some are choke points, and exactly one of them is the actual moat. The industrial robotics market is dominated by the Big Four. FANUC, Japan; Swiss, Swedish, headquartered in Zurich; KUKA, Germany, but we will come back to that one; Yaskawa, Japan. Together, roughly 70% of global industrial robot shipments. These are not new companies. FANUC was founded in 1972. ABB traces back to 1883. KUKA, 1898. Yaskawa, 1915. These companies built the factory floor of the 20th century. Their revenue is real. Their margins are real. Their customer relationships span decades. And yet, none of them is leading the humanoid race. The question is, who builds the factory floor of the 21st? Here is a story most people missed. KUKA, the German industrial robot icon, is no longer German-owned. Founded 1898 in Augsburg, Bavaria, long owned by Siemens, sold to Voith, another German industrial conglomerate, and then in 2016 sold to Midea Group, a Chinese appliance maker, for $4.5 billion. The German federal government tried to block the deal. They failed. KUKA today, Chinese-owned, headquartered in Bavaria, producing robotic arms for the world. This matters because the question of who owns the robotics supply chain is not abstract. It is already settled in some layers. KUKA was the canary. Watch the pattern repeat in materials, in motors, and in models. Inside industrial robotics, there is a subsegment growing faster than the rest: collaborative robots, Cobots. The market leader is Universal Robots, a Danish company owned by Teradyne since 2015. Cobots are smaller, cheaper, and safe to work near humans, without the fence and isolation that traditional industrial arms require. Universal Robots has installed over 100,000 units globally. The cobot market is roughly doubling every 5 years. Every Big Four player now has a cobot line. ABU-MI, FANUC CRX series, Yaskawa's HC, KUKA Iwa, the strategic point. Cobots brought robotics to the long tail of small and medium manufacturers who could never afford a fenced-off industrial cell. Cobots brought robotics to the long tail. Humanoids may bring it to the home. Pay attention to this pattern because it shows up everywhere in robotics. Symbotic, a warehouse automation company, went public in 2022 and currently has a backlog of over $25 billion in committed contracts. Its biggest customer is Walmart. But Walmart isn't just a customer. Walmart is also an equity holder. SoftBank is in too. The same pattern shows up at Agility Robotics, where Amazon is both customer and investor. At Figure AI, BMW is both customer and investor. At Aptronic, Mercedes-Benz is both customer and investor. When the customer takes equity in their supplier, two things are true. One, they are locking up capacity. Two, they are sharing tech obsolescence risk. This is structurally different from how the chip industry grew. Watch for this pattern. It is the tell of a deep structural bet. Now here is a story you probably haven't heard. Western media frames China as behind on humanoids. The data says the opposite. Uptech, a Chinese humanoid company, has its Walker S2 humanoid deployed in pilot programs across 7 Chinese auto plants. BYD, Geely Auto, Audi 4, FAW Volkswagen in Qingdao, Bayek New Energy, Dongfeng Liaoju Motor, and on top of that, Foxconn, SF Express Logistics. No Western humanoid company has comparable enterprise traction. Tesla's Optimus is still pre-production. Figure AI has a BMW pilot, but at 1 plant, not 7. While the West debates demos, China is running pilots at scale. That is the story. The Western humanoid roster. Each player has a different angle. Figure AI, Sunnyvale, California, full-spectrum factory and home humanoid founded by Brett Adcock. Reported valuation around $39 billion. 1X Technologies, Norwegian, focused on a domestic helper called NEO, OpenAI backed. Aptronic, Austin, Texas, enterprise-focused with a Mercedes-Benz pilot backed by Google and B Capital. Boston Dynamics, the legacy mobility leader, Hyundai owned since 2021. Agility Robotics, Oregon, building Digit in pilot at Amazon warehouses. Sanctuary AI, Canadian, cognition-focused backed by Morgan Stanley. Neura Robotics, Munich, Germany, building 4NE1 and bringing a fully European supply chain. 7 companies. 7 different bets on how the humanoid era unfolds. Most of them will not survive the next 5 years. The question is which ones do. Now let's talk about the OpenAI thing, because this is where it gets interesting. OpenAI does not officially have a humanoid product. They had a robotics team, they disbanded it, and they have since restarted it. But quietly, OpenAI has invested in 3 humanoid companies. Figure AI in their Series B, 1X Technologies earlier, and Physical Intelligence, the foundation model startup founded by ex-Google and ex-Stanford robotics researchers. 3 companies, 3 different bets, 1 investor. This is not how you back a winner. This is how you hedge. OpenAI is treating humanoid robotics like a portfolio bet, the same way Tiger Global treated software in 2021. The implication: OpenAI thinks humanoids will matter, but doesn't know who wins. That is a very different signal from picking one. Now look at Figure AI's investor list because it reads like a who's who of strategic capital. Microsoft, NVIDIA, OpenAI, Intel, BMW, Amazon, Jeff Bezos personally, Qualcomm, Salesforce, T-Mobile, ARK Venture Fund, Brookfield Asset Management, Macquarie Capital, Parkway Venture Capital, Mark Jeffrey. That list is not a list of typical venture investors. It is a list of strategic acquirers and infrastructure capital. When you see Microsoft and NVIDIA and Intel all in the same cap table, that is not three independent bets. That is three companies betting that whoever wins here, it will be platform-shaped, and they all need to be near it. The reported valuation is around $39 billion on no public revenue. That is not a financial bet. That is optionality on a new compute substrate. Here is the part of the story that almost nobody saw coming. Humanoid hardware is commoditizing fast. 10 years ago, an Atlas-class humanoid robot from Boston Dynamics cost well over $100,000 to research license, not to buy. Today, the Unitree H1, a full humanoid, walking with arms with onboard compute, sells for around $16,000 retail. The G1 series, Unitree's smaller humanoid, has SKUs ranging from a few $1,000s to maybe $20,000. By 2028, the floor is likely under $5,000. The hardware is not where the moat is. The hardware is where the price war is. Just like phones became commodity around 2015, humanoid hardware is collapsing toward cost-plus margins right now. The implication, the moat, whatever it is not in the body. It is somewhere else. And the Chinese humanoid wave is bigger than just UpTech. Unitree, headquartered in Hangzhou, ships 11 different G1 humanoid models, from basic to ultimate, plus the H1 and an H2 in development. They also make the Go2 and B2 quadrupeds. Their products are exported globally. Agibot, also called Zhiyuan Robotics, is funded by BYD, LG Electronics, and Tencent. Engine AI is competing directly with Unitree in the consumer humanoid segment. XPeng Motors, the EV company, has built a humanoid as a side project, running their own vision language action model called VL 2.0, plus a separate world model. The Chinese humanoid ecosystem is not just one company. It is an interlocking web of EV manufacturers, appliance giants, internet companies, and startups, all pushing in parallel. Vertical integration is the strategy. State coordination is the accelerant. And the battery, motor, and control systems already built for EVs get inherited by humanoids for free. So if the hardware is commoditizing, where is the moat? It is in the foundation model. Every serious humanoid player is building their own. Figure AI built Helix, announced February 2025. NVIDIA GR00T family, generalist robot 00 technology, has multiple versions. N1, N1.5, N1.6, N1.7, and N2. Google DeepMind built Gemini Robotics, plus their earlier RT2 model. Physical Intelligence has Pi 0 and Pi 0.5, explicitly cross-embodiment. Unitree has Unifo LMVL 0. XPeng is on VL 2.0. Hugging Face open-sourced small VLA. Tesla is adapting its full self-driving substrate to Optimus. The race is not about who builds the best body. It is about whose model generalizes across tasks, across form factors, and across robots they do not even own. Whoever wins the model layer wins the era. Now here is the data point that ties this all together. We ran a centrality analysis on the entire robotics knowledge graph, every mention, every relationship across 1,000 entities. The most connected entity is NVIDIA, 365 connections. Number 2 is Tesla, with 138. That is an 8.5 times lead over the second-place player. FANUC at 97. Symbotic and Figure AI tied around 56 and 57. Boston Dynamics at 48. Universal Robots at 47. The same pattern we saw in data centers, but more extreme here. NVIDIA is connected to almost every player in humanoid robotics. They sell the training compute. They sell the inference compute. They sell the simulator, Isaac Sim and Isaac Lab. They sell the physics engine, Newton. They have equity stakes in foundation model startups. They sell foundation models themselves. Don't sell components. Sell the operating system. And the data graph proves it is working. Let me name them. NVIDIA Robotics product line. The GR00T family, 5 versions so far. N1, N1.5, N1.6, N1.7, and N2. Then Cosmos Reason, Cosmos World Foundation Models, and Cosmos Transfer. On the simulation side, Isaac Sim, Isaac Lab 3.0, the Newton Physics Engine, Isaac GR00T Dreams, a synthetic data generator, Isaac GR00T Mimic, imitation learning. On compute, the Jetson Thor on-robot chip, the Jetson Orin family for development, DGX Cloud for training, plus equity stakes across the humanoid stack, more than 16 distinct AI products targeted at robotics. No other company has this surface area. NVIDIA is not selling robotics. NVIDIA is becoming the cloud for robotics. And just like in the cloud era, where AWS won not by being the best individual service but by being everything in one place, NVIDIA is locking in robotics by offering the full stack from synthetic data, through training, simulation, foundation models, inference, all the way to the chip running inside the robot's chest. Now the supply chain. The first choke point, rare earth magnets. Every humanoid robot needs precision motors. Every precision motor needs rare earth permanent magnets, neodymium, praseodymium, dysprosium, terbium. Together they form what is called NdFeB alloy. China refines roughly 85% of the world's rare earth supply. Not mines, refines. Mining is geographically distributed. Refining is concentrated. That is the choke point. The U.S. response. MP Materials, ticker MP, which runs the Mountain Pass mine in California. Apple invested $500 million in MP Materials. The U.S. Department of Defense took an equity stake. Lena's Rare Earths, Australian, is the other Western option. REEDEC in Norway is being built specifically as a refining-focused China alternative. But here is the unsaid part. China restricted rare earth exports to Japan in 2010. They have done it before. If they do it again, every Western humanoid program is hardware constrained within 12 months. The second choke point. Precision mechanical components, specifically harmonic drives and high-precision bearings. A harmonic drive is a type of speed reducer. It lets a small motor produce high torque at low rotational speeds without backlash, essential for humanoid joints. The market is dominated by two Japanese companies, Harmonic Drive Systems, ticker 6324.T, and Nabtesco, ticker 6268.T. There is a Slovak company called Spinia that supplies parts of the European market. That is roughly it. 3 companies for the entire humanoid era. For high-precision bearings, SKF Sweden, Schiefler Germany, NSK Japan. These are not new choke points. They have existed for industrial robotics for decades, but humanoid robotics needs them in volumes that do not exist yet. Capacity is going to lag demand. And now the surprise. A fully European humanoid stack is emerging, and the money behind it is from somewhere unexpected. Neura Robotics, headquartered in Munich, is building the 4NE1 humanoid. Their precision components come from Schiefler, German bearings, German engineering. Schiefler is sourcing rare earth from REEDEC in Norway, a refining company being built specifically to be a China alternative. So far that is a clean, China-independent European supply chain. Now the surprise. A recent strategic investor in Neura is Tether. Yes, the stablecoin company, the crypto giant that issues USD and holds over $100 billion in U.S. treasuries. They are now investing strategically in a German humanoid company. Why? Because the Chokepoint thesis is becoming explicit. If you control the picks and shovels of automation, the magnets, the motors, the models, you don't need to pick winners. You own the substrate they all run on. So pulling this together, the bridge thesis. Industrial B2B robotics is where the money is, 600,000 units shipped per year, mature margins, real customers. Consumer B2C robotics is where the narrative is, every consumer electronics show pitches the home robot. The interesting thing about humanoids is that they are the only form factor that plausibly bridges both. The same arm that picks parts on a BMW assembly line could, in principle, fold laundry in a home. That optionality is what is pricing the $39 billion valuation on Figure AI despite their having no revenue. It is not a bet on robots. It is a bet on which side of the bridge breaks first and what gets unlocked when it does. If the home market opens first, you get a billion-unit installed base. If the industrial market scales to humanoid-shaped solutions, you get the next FANUC. Either way, the substrate winner, the foundation model, the rare earth supply, the motor maker, captures rent. 4 things to watch from here. 1. Capital structure is .com VC, not infrastructure private credit. There is no Apollo or KKR equivalent for humanoid robotics. That means more boom-bust, fewer asset-backed lifelines. 2. Hardware will keep commoditizing. The Unitree H1 at $16,000 is not the floor. Expect $5,000 humanoids by 2028. 3. Foundation model winners compound. If Helix or GR00T or Gemini Robotics actually generalizes across tasks and form factors, that company captures the cloud margin profile of robotics. 4. The Chokepoint's rare earth harmonic drives foundation models, and as we have discussed in other work, photonics are where the asymmetric trades live. One closing line before the standard disclaimer. The robots are not the story. The supply chain is the story. Whoever owns the picks and shovels owns the era. This is research opinion, not investment advice. Do your own work. Thanks for watching.